Hello everyone, I'm Twinkle Jain and today we are going to talk about an essential topic, using mutual funds for retirement planning. Retirement might seem like a long way off, especially for Gen Z and millennials, but the earlier you start planning, the better off you will be. So, let's explore how you can select the right mutual funds to build a solid nest egg for your retirement. First, let's understand why mutual funds may be a great option for retirement planning. The main advantage is long-term growth potential. Mutual funds, especially equity mutual funds, have historically often delivered higher returns compared to other investment options like fixed deposits or savings accounts. For instance, the long-term average return for equity mutual funds in India has been around 12 to 15% per annum, whereas a fixed deposit might offer around 6 to 7%. But with higher returns come higher risk. That's why it's crucial to choose the right mix of mutual funds based on your risk tolerance and time horizon. For someone who is young and has 20 to 30 years until retirement, equity mutual funds can be a good choice because they offer the potential for high growth over the long term. On the other hand, if you're closer to retirement, you might want to reduce your exposure to equities and shift towards more stable investments like debt mutual funds. Let's break down the types of mutual funds you might consider for your retirement portfolio. First, equity mutual funds. They invest in stocks and have the potential to deliver high returns over the long term. Within equity mutual funds, you can choose from large cap funds, mid cap funds, and small cap funds. Large cap funds invest in well-established companies with a proven track record, making them relatively stable. Mid-cap funds and small-cap funds invest in smaller companies with higher growth potential, but they also come with higher risk. Second, debt mutual funds. These funds invest in fixed income securities like government bonds and corporate bonds. They are generally more stable and less risky compared to equity funds, but they also offer lower returns. Debt funds are a good option if you are looking to preserve your capital and earn steady income as you approach retirement. Third, hybrid mutual funds. As the name suggests, these funds invest in a mix of equities and debt. They offer a balanced approach, providing the growth potential of equities along with the stability of debt. Hybrid funds can be a good choice for investors who want to maintain a moderate level of risk while still aiming for growth. Fourth, ELSS, also equity-linked savings scheme. ELSS funds are equity mutual funds that come with a tax benefit under Section 80C of the Income Tax Act. They have a lock-in period of 3 years, but they offer the dual advantage of potential high returns and tax savings. ELSS funds can be a great addition to your retirement portfolio, especially if you're looking to maximize your tax benefits. Now, how do you go about building your retirement portfolio with mutual funds? The key is to start early and stay disciplined. Start with systematic investment plan, that is SIP, where you invest a fixed amount every month. SIPs are a great way to build wealth over time because they take advantage of rupee cost averaging, reducing the impact of market volatility on your investments. Another important aspect is asset allocation. As you approach retirement, it's wise to gradually reduce your exposure to equities and increase your allocation to debt funds. This helps protect your portfolio from market downturns as you get closer to needing your retirement funds. For example, if you're a 30-year-old and planning to retire at 60, you might start with an 80-20 equity to debt ratio. As you reach your 50s, you might shift to 60-40 or even 50-50 ratio, depending on your risk tolerance. It's also important to regularly review your portfolio. Life is full of changes and your financial goals may evolve over time. Whether it's a change in your income, lifestyle, or retirement goals, make sure to adjust your portfolio accordingly. Rebalancing your portfolio every year also ensures that you're on track to meet your retirement objectives. Let's not forget the role of tax planning in your retirement strategy. Mutual funds like ELSS not only offer the potential for high returns, but also help you save on taxes. By investing in ELSS, you can claim a deduction of up to 1.5 lakh rupees under Section 80C, which can reduce your taxable income. In conclusion, retirement planning with mutual funds is all about starting early, staying disciplined, and making informed decisions. By choosing the right mix of equity, debt, and hybrid funds, and by regularly reviewing your portfolio, you can build a strong financial foundation for your retirement years. That's it for today. I hope you found this insightful. Keep a lookout at this space for more such content. This is Twinkle Jain, helping you make smarter investment decisions every day.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.